Welcome to Subramani. I'm going to talk to you about some of the alternatives that debt investors have. When I mean debt investors, I mean that portion of your money which is invested in debt. All of us have an investment appetite for equity and an investment appetite for debt, and largely the debt appetite is met by people by going into bank fixed deposits. Largely, bank fixed deposit and post office deposits in India is really huge, much bigger than the mutual fund industry. And what are the alternatives? Why do people go for bank deposits? Simply because they have certainty. They know when they have to keep the money, they know when they will get it back, they know what is the rate of interest, and they know that in between, if they need liquidity, it can be broken. So it's a very well known product which your great grandfather, grandfather, father, everybody invested. So everybody knows that product and everybody sticks to that. Now, what are the alternatives which are available? One is you get the RBI floating rate bond. And like the name says, the rate floats, so there is some uncertainty with the next 6 months whether the interest will be higher or lower. Then there is the tax-free bonds which are available. Then there is PPF up to a limited amount of 1.5 to 3 lakh, 4.5 lakhs, which you can put in 2-3 names in your house, whether you get the tax break or no. And then there is Nippon India has something called a Nivesh Lakshya, which is a which is a long GSEC bond fund. And as I said, it's a fund, it's not just a single product. So it is a fund which invests in GSECs and AAA. So the chances of losing money due to credit risk there is very close to zero. Having said that, what do people look for in a bond investment? They look for certainty, they look for zero risk, they want the principal back exactly as it was, and a rate of interest which is predictable. Now, you can't get all this in a product which accept a bank fixed deposit, and the bank fixed deposit has a huge disadvantage that you don't get a positive real return. If you take inflation into account and taxation into account, banks give you a negative real return. So it's not an attractive way to invest, except a small portion which you need for liquidity. There you're not really looking for being very, it's not an investment product, it's a saving product kept there for liquidity. The tax-free bond which you buy is also got risk simply because interest rates have gone down after the bonds were issued. So these bonds are quoting at a premium. So when you go for redemption, you will definitely lose money. That brings us all back to something called NLF, Nivesh. I'll continue to call it NLF of Nippon, which is a product which is 23 years to maturity, and it has got very little, if any, credit risk. I would think it does not have any credit risk at all. The advantage is for anybody above 37 years of age, this is a very good way to defer your tax. You remember I said that bank fixed deposits are inefficient because of the taxation. In NLF, what you can do is put the money, maybe you're 37, 38 years of age, and you start putting your money now as an SIP or as a lump sum. Right now, it is being given to HNI clients for tax deferral and for estate planning, etc. So big lump sums are coming into it. Many people I know have put lump sums into it. I am suggesting going beyond that. You can also put a SIP into it. I have done an SIP into it, maybe a small amount. So whether you're putting 5,000 rupees or 10,000 rupees or 15,000 rupees, whatever is your appetite for debt, that is what you should be putting into it. And whenever there is an interest rate change, let's say today the interest rate for a 10-year GSEC is 7.6%. If you think that it won't go up further, you can put money. But what happens is interest rates fluctuate, interest rates change, then India gets into the MSCI index and interest rates can go down. All these things happen. Interest rates are as volatile as equity markets, if not more, right? So you start doing an SIP into it for whatever amount that you can afford, 5,000, 10,000, 50,000. And whenever you think, oh, interest rates have moved up very well, go and put a lump sum. So I do that. I do a small SIP, and whenever I have a lump sum, I put money into that, and I've got a very, very good return. I'm not mentioning the return because I don't want to raise expectation, and it's just not right to raise that kind of expectation. But I've done well over the last 6-8 months because interest rates have gone up. Right, so even in spite of the fact that interest rates have gone up, simply because I've stayed on in the fund for more than 5 years, I still have got a good return, and the lump sums have happened very late. So whenever the lump sum has happened, I have benefited by the interest rate movement, right? So you could also do that because when this fund was started a few years ago, the interest rates were higher, so they have had that lock-in. And more importantly, every quarter or every 6 months, whenever they get interest, that interest gets locked in at higher and higher rates if interest rates are going up. So that helps. And when interest rates go down, your portfolio anyway appreciates, right? When interest rates go down, the value of your portfolio goes up. So both ways, if you look at it as a long-term fund, don't look at it for 6 months or 8 months. Last 6-8 months you would have got good returns, but that does not mean you have to look at it as a short-term fund. Just like equity, treat it as a very long-termish thing. I mean, I'm treating it as the next 23 years. I'm not going to touch it. 2045 or something is the date when the fund will close down. So I've invested thinking I will invest till 2045. I have the liquidity. If I want, I can withdraw from 2042, 43, 44, 45, whatever. If I expect interest rates to change unfavorably, or if I think the amount is too high, so I may start withdrawing earlier. So the advantage is, instead of paying tax on a bank fixed deposit on a yearly basis, here I pay tax at the end of another 23 years. So postponing tax over a very long period of time, being able to sit tight, not worry about MTM losses. I know I'm going to hold it for 23 years, right? So I don't have to worry about MTM losses, which will happen anyway in any bond fund, and here it will happen because it's got a long duration. So any interest rate change against you or unfavorably will make the whole value fall. But however, like I said, since your new money is getting locked in at higher rates, you don't have to worry about that. Too many people think that long-term money should only be in equity. I'm a very strong believer that long-term money should be in equity. I still have a debt appetite, right? So I may be 80% in equity, but I may still have a 20% debt appetite, and that 20% may be much more than 4-5 lakhs, which I can safely put in a PPF. So beyond PPF, what do I do? NLF is a good way to invest your money and stay there for longish periods of time. Treat it like equity. Withdraw when you think, when you're getting, if suddenly you see interest rates have gone favorably and you got 17% return. It does happen in gilt funds, by the way. That's a great time maybe to withdraw and put it into a less volatile asset class, maybe like an ultra short bond fund. But you don't need to do that also. If you're anyway going to wait till maturity, it is likely to give you very good returns. So if you take the SIP returns in such funds, it may not be too great, but that is a great way to be accumulating units, because you will never be able to do a lump sum unless you have money. It's very unlikely that you sell your shares and put money into this. But I have done that. What happens is, when suppose equity markets are doing well and you withdraw some money and you're wondering where to put it, this is a good place to dump all that money, because this could serve as your retirement fund also, right? So you're now 50 years of age, or let's say you're even 55 years of age, you're going to get this money when you're 78. It does not mean you have to wait till 78, right? So at 70 you need money and the fund is doing well, it is giving you 9% kind of a return, simply because of the fact that you locked in at high rates and then interest rates have fallen. That's a great time to be removing money from that, paying the 10% tax, right? You get indexation benefit, so you're much, taxation wise you're better off. So that is the advantage of looking at this fund. Most mutual funds, including NLF, have two types of risk. One is the credit risk of a default and the interest rate risk. In this case, what happens is you give up completely on credit risk, and as a compensation you take a huge interest rate risk because of fluctuation. Now a 10-year GSEC and maybe a 2-year GSEC, the gap is not much. But still, if you are looking at something like 7.8% or 7.9% for a 20-year fund, then only NLF is the only fund which can get into that. Which means when the interest rates start going down, which it will, suppose India gets into the MSCI index and interest rates start going down, the value of this fund will go up. That's a great time perhaps for you to even withdraw. But always look at it as a long term 23-year kind of more for maturity, because it's 2045 maturity. So look at that, start doing an SIP for whatever amount. Don't treat this as only a fund for super HNIs and very ultra rich clients to put money here as a estate planning or things like that. It's a great product even for retail. So whatever is your capacity to do an SIP, do it, and whenever you have money, do a lump sum into it, and that's the way to improve your returns. And that's the reason why we do SIP in equity is, A, we don't have a lump sum. So if I tell you, if you put 1 crore away for your retirement, it will work. Yeah, but you don't have. So I have to break it down and say, okay, 25,000 rupee SIP, which will increase to 27,500 or 30,000, keep increasing. A rising SIP is the best way to accumulate money. Now this is a good way to accumulate money even in debt. So 80% of your SIP is going into equity, and 20% of your money can go into an SIP even in a debt product like NLF, right? So that is what this is supposed to do. Unfortunately or fortunately, small investors have looked at it only as a lump sum and said, oh, I don't have so much of money to put in a lump sum. I think I would recommend this as a direct, as a product for small investors, and a product for small MFDs also, to recommend to their retail clients. It's a good product because it's a 10-year, 15-year kind of a point of view, and suddenly if you think equity markets are going to do well, it's a great place to remove from and put it into equity. Though I would suggest that you hold on for the full maturity and pay tax on a deferred basis. These are the advantages that I can think of this fund, and please do look at it. Thank you.